In this video, we'll deal with a common unspoken perception among many that financial derivatives are risky and complicated, and perhaps they are better off with a mutual fund or a simple stock portfolio. But before we answer that, let's understand what a derivative is for those of you who may not know. A financial derivative is an instrument which is based on an underlying financial asset. In even simpler terms, think of a financial derivative as a financial product based on a financial product like a stock or an index. And another analogy can be an index ETF, which is a fund based on market index. And just in case you're wondering then about what is the difference between an ETF and a financial derivative, an ETF is a cash product. So when you buy an ETF, you pay the full value of the underlying. Whereas a financial derivative, on the other hand, is a margin product, which means that you pay only a small fraction of your purchase value, which is called margin, and it can be in the range of 5 to 10%. So, coming back to the question, are derivatives risky? In finance, risk is defined as the possibility that the actual return may be less than the expected return. Now, by this definition, a mutual fund or a stock portfolio can be very risky in the near to midterm, as even a small down move in price presents a risk and consequently value erosion of our portfolio. Options, on the other hand, allow us to hedge and even offset such a risk and make profits even if you're only partially right. Okay, the next part of the question, are derivatives hard to understand? Well, the short answer is no. And in this video series, we will go through all the concepts step by step to not only make you very well versed with options, but also enable you to trade the markets scientifically like professionals. And if you're thinking that these are difficult skills to learn and require complicated maths, that is not the case. All this requires is some simple mathematical concepts from high school, which we will refresh. But more importantly, it requires a high degree of motivation to learn and become good at it. It's important that you keep revising the topics, and very soon the concepts will start blending together and give you a nice, thorough, rounded, and more importantly, intuitive understanding. Okay, an important point. While financial trading is very lucrative, but it is akin to high speed driving. It will require fine calibration of risk and reward, trade adjustments, risk adjustment, timely profit booking, stop lossing bad trades, and so on. And all of these are concepts that we'll cover as we go along. But the point is, unless your portfolio manager or broker is an expert in options and reading markets, you are better off controlling your trades yourself. So please have a demat and a trading account which you control yourself. Alright, in the next video, let us build on the introductory and this video and see how options can help us significantly enhance the returns from our invested capital.